Welcome to unit number 5 of Principles of Costing. In unit number 5, we are going to look at labor costs. Labor costs is one of the 3 elements of costs. The other elements being materials and expenses. We have 3 elements of costs: materials, labor, and expenses. So let's look at labor cost as one of the elements of costs. Now, when we look at the topic labor, we will cover the following subtopics. We look at introduction or definition of labor. We look at what is called types of employees, analysis of employees' pay. We look at classification of labor costs. We will look at the concept of overtime. We look at accounting for labor costs. How do we account for labor costs? Remuneration methods and incentive schemes. These 8 subtopics will be covered in 2 sessions. So we are starting with the first session, and we are now focusing on introduction to labor. Now, what is labor? Labor is salaries and wages that are paid to employees. When we talk of labor, labor is a cost of producing the products of an organization, and it's always one of the major elements of costs. Now, when we talk of labor, labor is, we look at it in 2 categories. We have 2 types of employees. We have what we call direct employees, and we have those who we categorize as indirect employees. Direct employees are the employees who are involved in the ordinary activities of the business. Employees involved in the core business activities of the business. For example, if it's a furniture making business, employees who make the furniture are known as direct employees. And employees who support the process, support the production process, are known as indirect employees. For example, the CEO is an example of indirect employee because the CEO does not make the tables and chairs. So we classify employees into 2 categories: direct and indirect. Let's now focus on analysis of the pay of these employees, whether direct or indirect. And we are going to focus on what we call time-based remuneration, which we will later on come back to it. So when we talk of analysis of an employee's pay, if an employee is paid according to the time he has worked, the pay can be what we call basic pay for standard hours. There can be what we call basic overtime, overtime premium, and lastly, we have what we call allowances and bonuses. So when we are analyzing employees' pay, there is the basic pay for standard hours. For example, if in a day an employee is supposed to work 8 hours, the 8 hours are what we call standard hours. So what the employee is paid for the 8 hours is what we call basic pay for standard hours. But in a day, an employee can work extra hours. Any extra hour an employee works is known as overtime. Normally, the employee should be paid at a higher rate above the basic rate. So the extra pay the employee receives if he works overtime is divided into 2. There is what we call basic overtime and overtime premium. Overtime is one of our subtopics. And then finally, there are benefits the employee can receive in the business, and these benefits are allowances and bonuses. Allowances and bonuses. The third item, we are now looking at classification of labor costs. We have already seen types of employees. So these types of employees, we have said when they are being paid, there is the basic pay for standard hours, there is the basic overtime, there is the overtime premium, and there are allowances. Now these pay elements can be analyzed into direct labor costs or indirect labor costs. Any pay relating to indirect employee. Anything that is paid to indirect employee is classified as indirect labor cost. Anything paid to indirect employee. But now when we come to direct employees, we have basic pay for standard hours, and we also have basic overtime. Those two components are direct labor costs. But all the other components, that is the overtime premium, allowances, and bonuses, they come back to what we call indirect labor costs. I'm repeating, anything paid to indirect employee, whether it is basic pay for standard hours, basic overtime, overtime premium, or allowances and bonuses, so long as it touches on indirect employee, it is indirect labor costs. But for the direct employees, only the first two components are direct labor costs. The rest go to indirect. What are the first two components? Basic pay for standard hours for direct employees and basic overtime. That is direct labor costs. So we have seen that direct labor costs for direct employees, we are only looking at basic pay for standard hours and basic overtime. The rest go to indirect. So what goes to indirect? All pay for indirect employees. For direct employees, overtime premium, allowances, and bonuses. Now, we have already introduced the concept of overtime. Overtime is what is paid to employees when they work extra hours. The extra hours employees work is what is called overtime. Overtime is paid for usually at a premium, at a rate more than the basic rate, over and above the basic hours of pay. That is overtime. An example of overtime is given here. For example, if John is paid 10,000 per hour and overtime is paid at a time and a half, when John works overtime, he will not receive a overtime rate of 10,000. He will receive overtime rate of time and a half. You take the basic rate plus a half of the basic rate. A half of 10,000 is 5,000. So John will be paid an overtime rate of 15,000, which is 10,000 to represent the time and 5,000 to represent the half of the time. So the overtime rate will be 15,000. It is important that his pay is analyzed into direct and indirect. It is important the pay is analyzed into direct and indirect. Now, we have said that when you are paying overtime, you should pay at a higher rate. This extra amount paid over the basic is called overtime premium. Now, overtime premiums, all overtime premiums are indirect labor costs, apart from, number one, if an employee works at a specific request of a customer. If it is the customer who has requested the employee to work overtime, in that case, overtime premium is not indirect. If the customer has requested us to work overtime, overtime premium becomes direct labor costs. And number two, if overtime is worked regularly, in other words, every day the employee works overtime. If overtime working is regular or it's a routine, in that case, overtime premium will also be direct labor cost. So what are we saying in this case? Overtime premium is indirect labor cost, unless it's the customer who requested we work overtime or overtime working is a routine. Let's look at an example to enable us analyze this overtime. So we have an example with us. Vienna is a direct labor employee who works a standard 35 hours per week and is paid at a basic rate of 12,000 per hour. Overtime is paid at a time and a third. Time and a third. In other words, the basic rate of 12,000 and a third of 12,000, which should be 4,000. In a particular week, she worked 42 hours and received a bonus of 50,000. Required, calculate the basic pay for standard hours. Number 2, the basic pay for overtime hours. Number 3, overtime premium. And then finally, classify as direct and indirect. So let's go to our board and do that calculation. So we are being told in this example 1, we are analyzing our overtime. So there are a number of components we are looking at. Number 1, we want to look at basic pay for standard hours. Basic pay for standard hours. So when we are looking at basic pay for standard hours, here we are being told Vienna is a direct labor employee who works a standard 35 hours per week. So Vienna should be working 35 hours per week. So what is the basic pay? It is 35 hours times 12,000. So the employee is paid, if we go now to our calculators, we have 35 times 12,000. So the basic pay for standard hours is 420,000. 420,000. So that is basic pay for standard hours. Number 2, we are now looking at what is the basic pay for overtime hours. Basic pay for overtime. Now, the basic pay for overtime, the employee was supposed to be working 35 hours, but they worked a total of 42 hours. So they worked an extra 42 minus 35, which is 7 hours. So we come and have 7 hours are the overtime hours times the basic rate, the basic pay times the basic rate of 12,000. So that gives us, if we use our calculators, 7 times 12,000, it gives us 84,000. So the basic overtime is 84,000. But we were also told the employee is paid on a time and a third. The a third is the premium. So that leads us to number 3. There is what we call overtime premium. So for the overtime premium, we have 7 hours times a third of 12,000. It was time and a third. So a third of 12,000 is 4,000. So 4,000 times 7 hours. 4,000 times 7 hours, it gives us 28,000. Apart from that, so we've looked at basic pay for standard hours, we have looked at basic overtime, we have looked at overtime premium. Let's add maybe another item before we go to classification. So the other item that this employee was receiving was a bonus. So he was receiving a bonus of 50,000. So the bonus that was being received is 50,000. So what is the total pay or the gross pay of this employee? So the total pay of the employee is 420,000 plus 84,000 plus 28,000 plus 50,000. So the gross pay of the employee is 582,000. So that is what is the gross. And then if there is a tax, you deduct the tax to give you the net wage or the net pay. So for example, if the tax is 30%, you less 30% of 582. That's analysis of employees' wage. But we have also been told classify as direct and indirect. So from our previous explanation, we said that this basic pay for standard hours is direct. We also said basic overtime is direct. And we said the remaining ones are indirect. The remaining ones are indirect. So what is our total of direct and what is our total of indirect? The total direct is 420 plus 84. That gives us 504,000. That is the total direct labor cost. And the total indirect is 28 plus 50. 28 plus 50 is 78,000. Now, remember, overtime premium is indirect. But if we were told some two conditions are met, if the customer requested the employee to work overtime, this will change into direct. So 28 will change to direct if it is the customer who requested the employee to work overtime, and number 2, if overtime working is a routine. So that's the first example. We analyze the pay based on that. Maybe the last example is, if we go to a new example, now we have here, Carol is a direct labor employee who works 40 hours per week. Now we are changing from 35 to 40. She is paid a basic rate of 15,000 per hour, and overtime is paid now at a time and a third. The previous example, sorry, time and a half. The previous example was time and a third. In a certain week, she worked 50 hours and received a bonus of 100,000. So in this, our second example, example 2, again, we see the same analysis. So we start with number 1, basic pay for standard hours. So what is our standard hours? Carol worked 40 hours. So we have 40 hours times the basic rate of 15,000. So we have 40 times 15,000. If we do that calculation, it gives us 600,000. Okay, number 2, we have basic pay for overtime. So we look at basic overtime. Now, what were our overtime hours? The standard hours were 40, but this employee worked 50 hours. So the overtime hours were 10 hours. So 10 times a rate of 15,000, that gives us 150,000. Number 3, we look at overtime premium. Overtime premium. So what is our overtime premium? It was paid at a time and a half. Time and a half. So you take 10 hours times a half of 15,000. A half of 15,000, 7,500. 7,500 times 10 is 75,000. And then the last component is there was a bonus. And our bonus in this case was 100,000. So what is the gross wage? The gross pay or the gross wage is now 600,000. 600,000. We have 750, 850, 950, so that's 925. 925. 5,000 is the gross. And then you less any tax that is there to give you the net pay. But you are told classify as direct and indirect costs if overtime is worked regularly. So if overtime is worked regularly, the premium, the basic, and the basic, those three will be direct. It is different from the other example because in the other example, overtime was not worked regularly. So if overtime is worked regularly, the premium becomes direct labor cost. So what, and then there will only be one indirect labor cost. Indirect labor cost. So what is our total of direct labor cost? It is 600 plus 150 plus 75. It gives us 825, and this is 100,000. So we have done the analysis into direct and indirect. Our next item, after looking at classification or after looking at overtime, we now need to look for how do we account for labor costs. When you want to pay your employees, let's assume that the total wage bill for all our employees, maybe it's 10 million. All employees within the company, the total wage bill is 10 million. If the total wage bill is 10 million, we need to know how to account. To account is to now apply the concept of double entry. When you want to pay your employees, first of all, this money is taken out of the bank. You remove it from the bank. The money is removed out of the bank. So with the total pay, for example, if it's 10 million, you remove it from the bank and you take it to what we call a labor account. So labor account receives 10 million and the money, it leaves the bank account, the 10 million. So the account that receives, we debit. The account that issues, we credit. Now, once you have debited and credited the total wage bill, you now divide the wage into two groups, direct and indirect. So divide into two. You divide the pay, into two. Number one, you have what is called direct, and number two, you have what is called indirect. Assuming our direct is, it's an assumption, 6 million, and our indirect is 4 million. These direct will be taken to an account called work in progress account, and indirect will be taken to an account called production overhead. Now we analyze it as follows. For the direct, we debit an account called work in progress, which gives us the 6 million, and you remove it from the labor account that had received it. You credit labor account with the 6 million. You remove it out of the labor account. Now, for the indirect, you debit what we call production overhead account with 4 million, and you remove it again out of the labor account. Labor account 4 million. That is what is called accounting for labor costs. So with this illustration, we can now read what is in the slide. So you are being told under accounting, remember accounting means double entry. So what are we being told? Labor costs are an expense and are recorded in an organization's income statement. Accounting transactions relating to labor are recorded in the labor account. The labor account is debited, and that's why I debited with labor costs incurred by an organization. The total labor costs are then analyzed into direct and indirect. Analyzed into two, direct and indirect. For the direct labor costs are credited from the labor account for the direct labor costs are credited from the labor account and debited labor costs are directly involved in production and therefore transferred to work in progress. For indirect, the same, but we take it to an account called production overhead. It's taken to an account called production overhead, and I've illustrated the double entry. When cash is withdrawn, debit labor account and credit bank, what we have shown there. And then for the direct labor costs, debit work in progress and credit labor account. And for the indirect, debit production overheads and credit labor account. Let's look at an example. So we have an illustration there. Now, we have an example here. We have two groups of workers, direct workers, who are also known as direct employees, and we have indirect workers or indirect employees, and then their total wage bill, what is paid to all of them. So what is paid to these employees? Basic pay for standard hours, overtime basic, overtime premium, training costs, sick pay, idle time, etc. The above information is taken from the payroll of the company. So using that information, I don't even need to prepare the accounts because the exams is multiple choice. We need to know what goes to bank, what goes to labor, what goes to work in progress, and what goes to production overhead, because the questions will be multiple choice. So we start in this example, we do the analysis we have just done. Okay? So first of all, number one, we need to know the total pay. So what is our total pay? We have 60,000 plus 14,500, I'll call it 14.5, plus 7.25, I'm just removing zeros, plus 3.75, plus 1 plus 1.2. So this total wage is, let's get the total quickly, 60,000 plus 14,500 plus 7,250 plus 3,750 plus 1,000, finally plus 1,200. It gives us 87,700. So with this total, you debit labor account with 87,700 and you credit bank account with 87,700. Then you analyze the pay into two. So you divide the pay into two. Divide into direct and indirect. Remember we said the only direct affects direct workers and it's only the first two, 43,000 plus 10,000. So direct are 43,000 plus 10,000. So that gives us 53,000. All the remaining are indirect. So 87,700 minus 53,000 is indirect. So 87,700 minus 53,000 is indirect. So that's 34,700. Now with that analysis, you come and account for your direct labor cost. So what is our direct labor cost? We said you debit work in progress, and our work in progress will be 53,000 and you credit labor account. Labor account is also 53,000. And for indirect labor cost, you debit production overhead with 34,700 and you credit labor account with 34,700. And that is how we account for labor costs. Remember, in labor costs, these are labor costs. We can divide the pay into either direct or indirect. Direct goes to work in progress. Indirect goes to production overheads. Now, in our next item, we are now focusing on what we call remuneration methods. To remunerate somebody is to pay. To remunerate is to pay somebody. So when we want to pay our employees, we can either pay them depending on the number of hours they have worked or the number of units they have produced. If you pay somebody according to the number of hours they have worked, we call that time-based remuneration. To remunerate is to pay somebody. If you pay somebody according to the number of units he has produced, we call it output-based remuneration or output-related. Output is also known as piecework. Output is also known as piecework. So, let's have a look at time-based. Time-based remuneration is where you pay somebody according to the time they have worked. According to the time worked. So in time-based, all the overtime examples we have covered are time-based. Because in all the overtime, we covered two examples. There was an example where somebody was working 35 hours with a total number of hours worked were 42. And there was another example also. In that case, all those were time-based. So we will not repeat time-based. We go back to the examples on overtime. So let's go to the second one. Second one is called output-based remuneration system. Output-based remuneration system. Now, under output-based remuneration system, this is where you are paid according to the number of units you have produced. When we produce the number of units we have produced. So here, it is either straight or differential. Either straight or differential. So output-based remuneration, which is called piecework, is either straight piecework or differential piecework. Straight piecework or differential piecework. Now, in straight piecework, this is where one rate of pay, a fixed rate, is used for all the units produced. Fixed rate is used for all the units produced. So a straight piecework system is where a fixed amount is paid for all the units that have been produced. One rate of pay for all the units. It can be accompanied by guaranteed minimum wage. Guaranteed minimum wage is the minimum an employee can be paid. You know, every country have got what we call a guaranteed minimum wage. The lowest amount any worker can be paid. The lowest amount any worker can be paid. Now, let's have a look at this example to help us explain this concept of straight piecework. So the example reads, Aiden is paid 10,000 per unit and is guaranteed a minimum of 1.5 million for a 40-hour week. In a series of 4 weeks, he produced 4 weeks. He produced 130 units, 150 units, 170 units, and 180. But remember, there is a minimum wage of 1.5 million per week. So you are being asked, required, compute his expected pay for each of the 4 weeks. Expected pay for each of the 4 weeks. Remember, we are looking at straight piecework. Straight piecework. So we are looking at each of the weeks. How much did these people work? So I'll analyze into 2. We will look at what they worked and how much they were paid. It's important to understand this concept. So I'll start with week 1. Now, in week 1, we produced 130 units. So week 1, we have 130 times the rate of pay is 10,000 per unit. So 10,000. So that gives us 130,000. So 1.3 million is what they worked for. But there was a minimum wage of 1.5 million. Even though you worked for 1.3, because of the minimum, you receive the minimum. The minimum is 1.5. Week 2. Week 2, they worked for 150 units. So week 2 is 150 times 10,000. So that is 1.5. It is the same as the minimum. So they will receive the amount they worked for because it's the same as minimum. Week 3. In week 3, they produced 170 units. So 170 times 10,000. So that gives us 170, 1, 2, 3, 4. So 1.7 million. They will receive the 1.7 because it is more than the minimum. The rule is if you work for less than the minimum, you receive the minimum. But if you work for more than the minimum, you receive what you worked for. And week 4, they produced 180 units. So it is 180 times 10,000. So that is 180,000.8. They will receive 1.8. So what is their total pay for that period of time? So the total pay is 1.5 plus 1.5 plus 1.7 plus 1.8. It gives you 6,500,000. 6,500,000. And that is what we have as the total wage of this employee. The total wage of this employee. Number 2, differential piecework. Now, in differential piecework is where there is a scale that is developed of pay. What does it tell you? Differential piecework is a system which involves different piece rates for different levels of production. It is the most widely used piecework system. For example, if we now look at an example of differential, is where we have a scale. And the rate for each scale is different. As you produce more, the rate of pay becomes higher. So we have an example here. Braden is subject to the following rates of pay. The company, when it produces between 0 and 100 units, they are paid 1,500. Between 101 and 200, they are paid 1,750. Between 201 and 300, they are paid 2,000. And then now here you are being told the company pays a guaranteed minimum wage of 300,000, and in a week the employee produced how many units? 220. Calculate his earnings. So we are now in differential. Example 1. We want to know the employee produced a total of 220. Now this 220 will be driven through the scale. Out of the 220, there is the first 100 units. The first 100 units fall in the first category, and the rate of pay is times 1,500. Remember, the total was 220. We have produced the first 100, and then there is now the second 100 units to make it 200. And the second 100 units fall between 101 and 200. It is paid at 1,750. And then there is the extra units above the 200. It falls in this category of 201 to 300. The extra units are 20. So third is the 20 units. So this makes it a total of 220 times 2,000. So the first one is 150000. The second one is 175000, and the third one is 40000. So the total pay of this employee is 150 plus 175 plus 40. So that gives you 365. 365. That is the total pay of this employee. But the guaranteed minimum was 300. 300 is less than 365. They will receive 365. Remember, we have said if the guaranteed is more than the minimum, if the guaranteed is more than the worked, you receive the guaranteed. But if the worked is more than the guaranteed, you receive what you had worked. The next example is Betty is subject to the following rates of pay. The company pays a guaranteed minimum of 350, and in a week he produced 215. Now, in 250, example 2, so there is the first 100 units times the rate of pay is 1,200. There is the second 100 units and the rate of pay is 1,500. And there is the last 15 to make it 215. Third is the last 15 units, so that if you add, it comes to 215 units. And the last one is paid at 1,750. We have 15 times 1,750. 26,250. To give us the total pay is 120,000 plus 150,000 plus 26,250. So that gives us 296,250. 290, and the minimum was 350. They had worked for that, but the minimum is 350. The minimum. So they will receive the minimum because that is the least somebody can make. Finally, we want to look at what is called incentive schemes. An incentive scheme is a bonus. Incentive schemes are a bonus. So employees might be offered an incentive or a bonus for improving their productivity. An incentive scheme is a bonus. Why do we have incentive schemes? Number one, to increase the total production output. We give a bonus to enable employees improve on their productivity. And number two, to achieve the same total output volume, but in a fewer what? Hours. We give a bonus to enable employee to work faster and achieve a certain output level. Incentive schemes can be aimed at individuals or groups. When you are rewarding employees with a bonus, we have what we call rules that you follow when giving out a bonus. There are normally 4 rules when you are giving out a bonus. Number one, they should be related to the effort of the employee. The bonus you give, which means if employee gives more effort, he receives a higher bonus. If he gives less effort, he receives less bonus. Number two, they should be agreed between the employer and the employee. Don't give a bonus before you agree with the employee. And number three, they should be easy to understand. Every employee must know how his bonus is calculated. And number four, they must be beneficial to all. You must be fair in giving out the bonus. They must be beneficial to all. Now, when calculating bonuses, there are 2 types of bonuses. We have what we call Halsey scheme and Rowan scheme. So Halsey scheme is where the employee is paid a bonus which is equal to 50%. So the bonus received is 50% of the time the employee has saved. Remember, the second reason for giving out a bonus is to enable employee work fewer hours. So this bonus called Halsey is where you receive 50% bonus of the time you have saved. So you will take time allowed, the standard time, minus time taken, divide by 2 times the rate of pay. The second scheme is called Rowan. Now, in a Rowan scheme, it is quite different. The bonus is calculated as time taken over time allowed times time saved. We will have an example to enable us as we come to the end of this topic. So we'll have 2 examples. The first example, example 1, as we come to the end, okay? Number 1, the following information was taken from X Limited. The employee's basic rate is 6,000 per hour. Allowed time is 50 minutes. Time taken is 32 minutes. Calculate the total payment for the employee. So in this case, number 1, we need to calculate using which one? Using Halsey. So I'll use number 1, Halsey scheme. Halsey scheme. Now, in a Halsey scheme, A, the bonus, we have said it is 50% of the time saved. So it was time allowed was 50 minutes minus time taken is 32 minutes, divide by 2 times the rate of pay. The rate of pay is 6,000 per hour. So because it is per hour, we must convert these minutes into hours. So we'll multiply by 1/60 to convert the minutes into hours. And then you multiply by the rate of 6,000. So that gives you the bonus. And then there is a basic pay. You are not only paid the bonus. So the basic pay is the time taken. Time taken is 32 minutes. I'll divide by 60 to convert it into hours times 6,000. So that is under Halsey. Number 2, under Rowan scheme. Under Rowan scheme, the bonus will be, we said time taken over time allowed. Time taken is 32 Overtime allowed is 50 times time saved. 50 minus 32 is 18. Whatever you get, you multiply by 1 over 60 and then times the rate of pay of 6,000. We are winding up. B, the basic pay does not change. Basic pay does not change. So it will be 32 over 60 times 6,000. So let's get these two answers and then we conclude. So 32 divided by 60 is 0.53 times 6,000. It gives us 3,200. The first one there is 32 over divided by 50 times 18 divided by 60 times 6,000. It gives us 1152. So what is the total pay of this person? The bonus is 1152 plus the basic pay is 3,200. So that gives you 4352. Here, this does not change. This is 3,200. What about the bonus? 50 minus 32 divided by 2. It gives us 9 divided by 60 to change it into hours times 6,000. It gives us 900. So the total pay in this case is 900 plus 3,200. And that gives us 4,100. Example 2 will be an assignment. Example 2 will be an assignment that you should create time and practice on it. And that brings us to the end of the topic, labor. What have we looked at? Introduction, defining labor. We have looked at classification of employees into direct employees or indirect, classification of labor into direct or indirect labor costs. We have looked at accounting for labor. We have looked at overtime. We have looked at remuneration methods. And finally, we have looked at incentive schemes. This brings us to the end of this unit, labor cost, which we have covered in one session. Thank you. Welcome to the last unit on principles of costing. This is the sixth unit, which is called comparison of costs and income. Remember, costs are what we spend. Income is what we receive. So we are comparing what we spend versus what we receive. In this unit, we are going to look at the following: introduction, which we have already said what we spend versus what we receive. Number 2, comparison of actual results with budgets. Number 3, when does a variance arise? We will explain what a variance is. How do we find the variance? How do we calculate the variance? How do we report a variance? And who do we report the variance to? That is called reporting lines. And finally, some 2 examples on calculation of variances. So let's start with the introduction. One of the 3 most important purposes of cost accounting is control. Remember, there are 3 purposes of cost accounting: planning, control, and decision making. So control is one of the 3 items in management or cost accounting. So what is control in this case? Control may be assisted by comparison of actual information with the plan. A plan in this context is also called a budget. A budget in this context is also called a standard. So when we compare actual information or actual results to the plan, and you get the difference between the plan and actual, and you investigate the cause of the difference, that is what is called control. So what is control in summary? It involves comparison of actual results to the plan to get the difference and investigate the cause of the difference. This difference, later on we will see, it's called a variance. So this difference between plan and actual is called a variance. Comparison of actual results and budget. We have said the difference between actual results and budget, remember a budget is also a plan, a budget is also a standard. The difference between actual results and the budget or plan or the standard is called a variance. Now, variance, this difference can either be favorable or adverse. Favorable when the variance is good for the business. Adverse when the variance is to the disadvantage of the business. In other words, bad for the business. So variance can either be favorable or adverse. When do we have favorable variance and when do we have adverse variance? Favorable variance arises when, number one, the actual cost is less than the budget. In other words, the actual cost you spend, what you spend is less than what you budgeted for. That is favorable. Or if it is income, the actual income is more than what you budgeted. So favorable arises in two cases. Number one, when actual cost is less than budget or actual income is more than budget. On the other hand, the opposite of that is adverse. Adverse arises when actual costs are more than budget or actual income is less than budgeted. How do we find a variance? Managers will want to be made aware of significant variances, whether they are adverse or favorable. Managers should not investigate all variances. Managers should only investigate variances that are significant. You don't need to investigate all differences. You only need to investigate a variance. Remember, variance is a difference between budget and actual. So if this difference is huge, you investigate. If it is not, you don't investigate. So you only investigate if it is what? Significant. Now, only investigate variances above a certain what? Percentage. So significance is something that is relative. Significance is not a certain amount. Significance depends on the size of the business. So managers should not only investigate adverse variances, but sometimes they should also investigate what? Favorable variances. Why? Because sometimes a favorable variance is an indication of a job well done. So you should also investigate what caused the favorable, even though it is beneficial. Favorable indicates two items. Number one, it's a job that is well done, or the targets that were set were not good. The second point, the fact that the budget was not a fair reflection of the cost. So sometimes you have good results because of two reasons. Number one, you performed well. Number two, the target was wrong. If the target was wrong or was low, you will perform well. So those are the two causes of favorable variances. So all variances, whether favorable or adverse, should be investigated. How do we report variances? The significant variance or the significance of a variance cannot be determined simply by its size. We have already said that. Note that if it is 1 million, it is significant. 1 million is relative. 1 million depends on the size of the business. To Bank of Kigali, 1 million may not be significant. But to my business, 1 million is significant. So significance depends on the size of the business. So there is no rule that if it is 1 million, you investigate. No, it depends on the size of the business. That's what we are trying to explain here. The size of the variance must be compared with the budget. For example, a variance of 50,000 is tiny compared to a budget of 500 million. The significance of the variance will therefore be determined by measuring the percentage of the budget figure. So in other words, we need to get percentage of a variance. How do we get variance percentage? Variance percentage is budgeted results minus actual results divided by budgeted results times 100. Budgeted results minus actual results divided by budgeted results times 100. Now, who do we report a significant variance to? For example, if it is an income variance, we report it to the sales manager, or the sales manager is responsible for it. If it is a material variance or material cost variance, you record it to purchasing manager or production manager. If it is a labor variance, you record it to production manager or human resource manager. And finally, if it is an expense, you record it to the administration manager. We are coming to the end of this by looking at two examples. This was a topic that is not complicated. This topic only looks at the difference between budgets and actuals. So we have an example, two examples actually. Given below are the income. Income is money that comes into the business. Given below are the income for each of Habimana's profit centers. So there is a profit center called apple, oranges, and mangoes. The actual income and the budgeted income. Required, calculate the variance in each center and the percentage. So in this example, example 1, you are asked for two items. Number 1, you are asked for variance, and number 2, you are asked for percentage of the variance. So you are asked for variance and you are asked for percentage. So number 1, apple. Remember, these are income variances. It's important to know the type of variance. Income is money that comes in. So we had budgeted with an income of 180 million. That is 180 minus actual is 189 million. So this gives us a variance of 9 million. You don't write positive or negative. You just write it the same way it is. So in this case, the percentage is 9 million over the budget was 180 million times 100. So 9 million, 9 divided by 180 times 100. It gives you 5%. That is the first variance. The second variance is on, now variance can either be favorable or adverse. We had budgeted to receive 180. We received 189. So in this case, we received more than what we had budgeted. So it is favorable. Because we benefited, we received more. The next one is oranges. Now in our oranges, we had 157, 295, 250 minus 145, 926, 125. So this gives us a variance of, let's look at it, 157, 295, 250 minus 145, 926, 125. It gives us a variance of 11,369,125. What is the variance percentage? 11,369,125 over the budget was 157, 295, 250 times 100. So that gives us divide by 157, 295, 250. So that gives us times 100. It gives us 7.23%. 7.23%. The last one is 3. It's mangoes. For the mangoes we have 86 million minus 98 million. $86 minus 98, that gives you 12 million. So percentage is 12 million over 86 million times 100. So 12 million divided by 86 times 100. So that gives you 13.95%. So here we had budgeted to receive 86, we received 98. So this is favorable because we gained. Here we had budgeted to receive 157, we received less. So this is adverse. The last example is the following statement shows the budget and actual results for the month of October for Department X. Month you have been given, the variances you have been given. Calculate the variance for each item in the statement and calculate the percentage. So in this example, we will follow the same analogy. So we'll have variance and we'll have percentage. Variance and we'll have percentage. So I'll start by getting the sales. What is our sales variance? Budget and actual. Budget was 600,000 minus actual was 550,000. So the difference is 50,000. Budget was more than actual, so it is adverse. So adverse because your actual is less. So it's adverse, so it will be 50,000 percentage over budget is 600,000 times 100. So that gives you 50 divided by 600 times 100. So that gives you 8.3%. So that is sales. And you repeat maybe one more, two more. Direct materials. Let's look at direct materials. So in direct materials, 150 and 130. So we'll have 150,000 minus 130,000. So that gives you 20,000. But remember, now this is expenditure costs. We had budgeted to spend 150. We spent less. We gained because we saved. Favorable. The percentage is 20,000 over 150,000 times 100. So we have 20,000 divided by 150,000. It gives you times 100. It gives you 13 0.33%. Maybe the last one, so that the others you are in a position to do yourselves. Labor, direct labor. The same, just illustration. Labor, it is 200,000 minus 189,000. So that gives you, is it 11,000? It's a cost we spent less, so it is favorable. The percentage is 11,000 over the budget of 200,000 times 100. And that gives you 11,000 divided by 200,000 times 100. It gives us 5.5%. So what is a variance as we conclude? Variance is the difference. Variance is the difference between budget. A budget is also called a plan. A plan is also called a standard. The difference between budget and actual results. We have seen variances can either be favorable or adverse. When do we have favorable? For costs, when actual costs is less than budgeted, it's favorable. For income, when actual income is less than budget. For income, favorable. When actual income is more than budgeted, budget, it's favored. For adverse, when actual costs are more than budgeted, it is adverse. For incomes, when actual income is less than budgeted, it is adverse. And we have said you only investigate significant variances. When are variances significant? It depends on the size of the business. You need to calculate what we call percentage of the variance. Percentage of variance is the difference over budget times 100. And that brings us to the end of Unit 6. Which units did we look at in principles of costing? The unit number 1 was Introduction to Cost Accounting. Unit number 2, Cost Classification. Unit number 3, Cost Behavior. Unit number 4, Materials. Unit number 5, Labor Cost. And unit number 6, Comparison of Costs and Income. That brings us to the end of this module. In the last session, as we conclude, we'll be revising some few past paper questions from each topic. So let's meet in our revision session next. Thank you.